I mean, we come from this from the perspective of a global investor, and from a global investor's perspective, there are always things that concern you in global markets. This adds to the list, if you like. I mean, if you go around Europe, I think if we were to list the things we worry about around Europe, probably the Italian budget situation would be the most worrying for us. You know, will Italy and Brussels come to an agreement on the Italian budget? Then we would probably worry about Brexit. I mean, although the chances of a hard Brexit seem quite low, that would have a big impact on a reasonably large European economy. The Spanish announcement today about elections, when I go around Madrid and I ask Spanish people about that, they all tell me that the Spanish economy does really quite well when the government is in transition and there isn't a government, so it would be less to worry about. So I listen to them and that's what they tell me. I think it adds to the list of things to worry about in Europe. But every country has things to worry about. The US has just had a government shutdown. They have probably a president who is maybe less predictable than previous presidents. You know, China is having a debt issue, so there are problems in any country. I think this certainly adds to the list of political worries around Europe, which are a concern for investors. Well, I think so. The capital is a long-term, bottom-up, stock-picking investor, if you like, and you know, our approach to these things is not to try and predict difficult or unpredictable political events and invest on that basis. Our approach is to try and find well-managed, broadly diversified companies we think will do well in the long run, do our research and then invest in those and hold them throughout. We tend to find they tend to be more resilient to individual events in individual countries, and that's our way of investing. So we try and analyse political events. I don't think we are better than any other investor in predicting the outcomes of those, but they will all get resolved. I mean, presumably at the end of this year, Spain will have a new government, maybe Italy will have come to an agreement with Brussels, and the UK will have left or not the EU. So they will all be resolved, and in many cases it's the run-up to that event that is most stressful to investors. When that event is resolved, investors can get on worrying about the next event. An excellent point. No, you're right. So the New Perspective Fund, the fund that we've been talking about today, specifically excludes companies that operate in only one country because they are vulnerable to events in that country. So the one thing we do in New Perspective is try and exclude domestic companies. We tend to wait until a company has generated more than 25% of its revenue outside its home country before we invest, because we think they are more resilient and they can stand a temporary slowdown in one country because they've got multiple regions in which they operate. Well, we look for growth rather than resilience. So I think, you know, for 46 years, this fund has been trying to find companies that benefit from changing patterns of global trade. And I guess the exciting thing at the moment is there are more and more companies that are benefiting from changing patterns of global trade. Our biggest holding is Amazon, that we've held for more than 12 years, and that is a very clear and obvious example. It benefits from people moving their shopping habits from high street to online. It also benefits from companies moving their computing from in-house to outsourcing it to cloud computing businesses. So it's captured two what we think are very long-term trends, and we plan to be very long-term investors in Amazon to benefit. One of the interesting things about this environment is that the value of being number one on a platform seems to be immense, and there is almost no number two. You tell me, who is number two to Amazon in global online shopping? There doesn't seem to be one. Who is number two to Facebook in social media? There almost doesn't seem to be one. Who is, you know, in many cases, who is number two to Uber? You have one in Spain, but globally, you know, the market leading platform is where all the value tends to lie. So it's from an investment perspective, you know, investing in the number one platform has been very rewarding. Investing in the number two or three has been very disappointing for the last few years. So broadly across capital, actually, of all these so-called FANG stocks, Apple is one we are very lightly invested in. We do have some shares, but it's actually quite a small holding for us. We've worried about many things with Apple, and let's be clear, Apple has been a fabulous company, and it's been a very rewarding investment. I guess we've worried about a few things. One is their propensity to push prices up, and they have made the latest generation of iPhones astonishingly expensive. Also, the amount of effort that competitors to Apple put into replicating Apple, so be it Samsung or be it Huawei or be it Oppo, a huge amount of effort goes into copying Apple phones, and Apple's technology leadership looks like only being 1 or 2 years. I mean, it only takes 1 or 2 years before an iPhone competitor seems to have all the devices and gadgets and apps that an iPhone has, and that is a pretty slim lead for the company that takes the vast majority of profits from manufacturing iPhones. I mean, many companies manufacture mobile phones, only Apple makes a profit out of it. That's a vulnerable position, arguably. Well, we have political analysts. We listen to them. They're often no more right than tossing a coin. But their view is that Donald Trump has talked for years about unfair trade practices in China, so this is not something that will be over quickly. He's also surrounded himself by advisors who have got long-held views that China doesn't trade fairly with the rest of the world. So this is something we fear could go on for many years. We observe that the companies most vulnerable to that are companies and industries with long supply chains. So, the auto industry or the chemical industry, and German companies in particular feature long supply chains. So we worry about that. I mean, this fund doesn't actually have much exposure to companies that move bits of metal or infrastructure around the world. I mean, the biggest holdings are technology companies, knowledge companies, where it's data moving around the world that is the key, and our sense is that there is no risk to that from the current sort of trade negotiations between the US and China. So the fund has for 45 years tried to invest in companies that benefit from changing patterns of global trade. It's been through many phases. It's had exposure to the oil sector. It's had exposure to consumer goods. Currently, it is in this sort of the bias is towards these knowledge companies. Our biggest holding is Amazon, for reasons we said, but we also own TSMC, that's a big supplier to the Apple supply chain. We own Facebook, we own Netflix, and we own that sort of company. It's a diversified portfolio. It's more than 200 holdings, so it's not just in those companies, but that's the area we find most. For a fund that invests in companies benefiting from changing patterns of global trade, I think actually our energy exposure is away from oil producers. I don't think that necessarily means that oil price is going to be very weak, but we just find more attractive opportunities in green energy companies or pipeline companies rather than actual oil producers. There's a big debate, a separate debate to be had about the impact of peak oil. Many investors seem to think that peak oil is bad for the oil sector. There is an argument that as oil companies pull back their capital expenditure, do less exploration and production, producing less oil, that the oil price equilibrium could be at a higher level than people expect. That would make the oil companies quite attractive. So that's a discussion we're having internally at the moment. I think that's quite an interesting discussion. We do. Over many decades, we have found many companies in Spain we like. We've been investors in Inditex from the very first time it floated. In this fund at the moment, we have investments in Amadeus and in Grifols, which we on a global basis think have excellent technology and are well managed. And so there are a couple of the positions we have at the moment. Generally, across capital, no. Very worrying for those of us who work in the financial services industry that no, if you look across all capital funds actually, we are quite lowly exposed to banks. I guess the future, we ask our managers to pick their highest conviction investment ideas, and they very rarely choose banks. I think the long-term future for banks is very, very hazy. It's not clear that banks are particularly well liked by their customers. It's not clear they're very good at managing their IT infrastructure, which would say will be key requirements for being a successful bank. So actually we have very modest bank exposure. Yeah, there is, and it's very interesting. It's something we've devoted lots of time and thought in trying to understand. So, for a fund, and I'll repeat myself, that invests in changing patterns of global trade, in a way, the old auto companies are less attractive. So, they are possibly disintermediated by the likes of Uber or the likes of Tesla. So the only car manufacturer we own is actually Tesla. It's quite a controversial company. We're happy to defend our investment. We've held it for 3 years, and it's been a good investment, although very volatile. But we do think about the impacts of self-driving cars on other industries. Will owners need to insure cars that are self-driving? What's it mean for the motor insurance company? One of our analysts recently pointed out that if you're sitting in the back of your self-driving car reading on a tablet, will you be looking out the window looking at billboards by the side of the road? So should we invest in billboard companies? So I think this change in the way that people use cars and move around is going to have lots of implications. But at the moment we find ourselves being cautious. We do observe that Google has invested a lot of money in Waymo, its self-driving car subsidiary, and we think they do have some excellent technology that's hidden away in the complexities of the alphabet business. I'm not sure, and I'm not sure actually the Tesla share price cares much about that. I think delivering on their ambitious growth plans in a sensible and professional way is the key for Tesla. But it does seem to have established an enormous lead versus the traditional car manufacturers in capturing their gigafactory in California, now building one in China. They are a big competitive advantage they seem to have.